Welcome to the Market of the Moment, week of August 8, 2022. Michael Oldham with Chris Madrid. What's up?
Hey, man. So good to be here. So good to be here.
Always good to be here on a Thursday. Getting going.
Yes. Yeah. There's been a little bit of movement in the market downward, thankfully, right? So 30-year on average, I think we're down to the low fives, so 5 1/8 or so. On conventional financing, right? 15-year financing is still in probably the mid 4 range or down a little bit to the mid 4 range. Jumbo loans, which, depending on the market that you're in, normally in North Texas, right, is a loan amount above 647,200. So that is the jumbo limit. So anything above that is classified as jumbo, and those rates are in the the high fours. So 4.6, 4.8 range probably is where you're looking for those. And then this is great, which I love talking about. FHA and VA, we're now seeing those rates down in also the high fours. So 4.6 to 4, that 4.8 range. So if you're purchasing a home as a first-time home buyer or utilizing your VA benefits, that's a great option. But over the last several years, we've seen typically that VA and FHA rates are lower than your normal conventional options. So that's where they're at currently. There's still a lot of unknowns, right, in the market. So we're talking about trends and where we see interest rates going. Like we've talked before, the biggest issue with mortgage rates, or that we've seen mortgage rates go up, is inflation, right? So as the Fed continues to combat inflation by means of bumping up the federal funds rate, we know that next month that's going to be 50 basis points, possibly 75 basis points, most likely 50, right, is where they're going to be increasing the federal funds rate next month. That tells the bond market that the Fed is serious about inflation and combating inflation. So the market right now is a little mixed on it, but over the last week we've seen mortgage-backed securities tick up, which has helped interest rates. A couple weeks ago we were in the mid fives, right? So mid to high, so 5.5 to 5.7, something like that, and we're now down in the 5.1, 5.3 range, which is great. So as long as we see that 100-day moving average is what we're looking at. It's the purple line. So if we can break above that, then there's a lot of room to the upside, and that will definitely help interest rates long term. If we go back to June, right, if we were just to draw a line from June 13, that's the date that's there, up till about today, right, it's an upward trend. Now there's been some downward pressure, right, but if overall it follows that upward trend, and we're moving in the right direction, which would be great. But ultimately it's still, there's still a lot of unknowns. There's still, Russia, Ukraine going on. There's all these other potential food, these water shortages and food shortages and all this other stuff that we keep hearing about. Starting off this morning, stocks and bonds were higher than expected because of the PPI report that came out. And if everybody's noticed, I went to the pump yesterday, $3.50 for premium at the pump, right? So just looking at the different gas prices, and yeah, $3.53 I think it was at the good old Costco pump station. So that makes me happy. Anything under $4 is great for a gallon of gas. But yeah, overall, until this inflation stuff, again, the Fed has come out and said, hey, our target's gonna be 2%, right? There's a long ways to go from where we're at currently. So yeah, so hopefully it continues this trend. Again, for at least the next year to I don't know, now we're revising 8 to 12 months, right? There's just as much probability that we'll be down in the low fours as it is that we'll kind of stay in these ranges that we're in now, right, which is high fours to low fives. So yeah. Again, to the 2% range, maybe even 3% range, I think is pretty far off. So if that's what you're waiting for to buy a home, you're gonna be waiting a while, right? Because I think those are gone for a while, for a long while. But yeah, I mean, I think the normal 4 to 6, right, is typically where, like, historically rates have been, over the last 30 years or so. Like we've talked about before, the 50, 60 year average of mortgage rates is 8% or so, 8.5%. So man, 4 to 6% is great.
All right, let's take a look at our next slide.
Yeah. So yeah,
this
was absolutely. Yeah. So MBS Highways, a service that we use quite a bit. And this was a national housing survey, which they do this. And I think it's great because of, as you and I talk about, a lot of the misinformation that's out there, right? So where these news agencies, these news outlets, are saying, hey, housing's crashing, this bubble is about to burst. This survey comes from, from guys like you and me, right? In lending and real estate, that are providing data like, hey, we are now, I think their overall consensus is, if we just look at the chart here specifically, we're in the green section, right? Which is, which Texas, a lot of this, I'm taking this as we are essentially back in a normal market, right? Where it's going to take, like we've talked about before, if you put your home on the market, it's going to take 2 to 4 weeks to get a contract, and it's going to take another 2 to 4 weeks to get closed, right? Which is, in my opinion, a normal market. If you get under contract in less than 30 days, hey, that's great, right? So I just I wanted to show this just to give an idea of where, we're boots on the ground, right? Real actual, people that are in the industry is providing this information. There are still some areas, right, that have kind of a, rapid multiple offers, and we see that here, right, in Dallas and in Collin County. A home that is nicely done, recently updated, when it's 500 degrees here in Texas, and you have a pool, those suckers are probably going over list, and you're getting multiple offers, right? But your traditional homes are probably selling pretty close or right at list, and they're going under contract in 3 to 4 weeks. So I just thought this was some good real time data, right? Because the things that we talk about, we want them supported by data, not just